Hello guys, welcome to Guide to Stock Market. Today we are going to discuss about the fundamental analysis of HDFC Bank. So HDFC Bank Limited, one of the largest and biggest private sector banks in India, they have declared their final year, that is Q4 audited results on Friday. So let us go inside the fundamental analysis of HDFC Bank Limited. Disclaimer: the analysis has been prepared for informational and educational purpose only. It is not and should not be regarded as an investment advice or suggestion for any course of action. You are not a SEBI registered advisor. Only this video is only for educational purpose. Okay, let us see the history and management of HDFC Bank Limited. They started their banking operation in 1994. Before that, they were being into NBFC kind of business. In 1995, they have come up with an IPO, and at present, they have totally 5,400 plus branches across India and around like 15,000 ATM banks. And they have merged Times Bank in 2000 and Centurion Bank in 2008, and recently they have invested in Yes Bank also. And CEO is Mr. Aditya Puri. He was being the CEO from 1994, and his tenure is going to end soon. Let us see who is going to take over as a CEO. The recent news for banking sector is repo rate has been reduced by 75 bps, that is 0.75 percentage, and cash reserve ratio is reduced by 100 bps, and reverse repo rate is reduced by 25 bps. And due to corona issues, they have given a 3 month moratorium period for all the loans given by banking as well as NBFC sectors. So repo rate is basically like the banks get loan from RBI, so that is what we call it as repo rate. Cash reserve ratio is the ratio. Uh, Basically, it was around like 4 percentage, I think 3 percentage. It is a ratio. It is a cash that to be deposited in Reserve Bank of India by the banks for their banking operation. It is a mandatory thing. And reverse repo rate is a loan given by banks to the RBI. So that is called as reverse repo rate. And due to this moratorium period, in the long run, banks may get more interest income. So that is a positive for this banking and NBFC sectors. Now let's go into the fundamental analysis. Their loan book as well as their corporate loan has been good, performing good. And if we could see, like recently, one of the FIIs have acquired more than 1.3 percentage of their share. And let us see their shareholding pattern. Their shareholding pattern reducing quarter on quarter. That is not a good sign. And the PE is 19.8. It's in good shape when compared with the industry PE of 25.75. Let's go into the fundamental analysis of their financials. So the gross NPI is reduced from 2019 to 2020, and the net NPA percentage is around 3.36, and it has been reduced from 2019 to 2020. We can see a gradual reduction in NPA for the past 4 years, and the net interest margin is 4.3 when compared to 3.45 percentage. It's in a good shape. They have a good interest margin. And the PB ratio is 3.25, which is also good. And their earnings per share is reduced drastically from 83.3 to 49.8 in this current results. So, which is not a good sign. Let us see where it has gone. So, provisions and contingencies are the amount that is being deposited for the bad loans, like a backup plan for the bad loans. So if you could see, the provisions has been increased to 13,700 crores from 8,383 crores. So it has been a big allocation for this provision. So that might be a reason for reduction in their earnings per share, and there might be other underlying reasons too. The CASA ratio also it's reducing drastically. So current account versus savings account percentage, the ratio, so it is being reduced. So it's not a good sign. And if you could see, they increased their income from 2019 to 2020 from 1 lakh 24,000 crores to 1 lakh 47,000 crores, which is a good sign. And their income is being consistently increasing for the past 5 years. And let us discuss on the quarter on quarter results. So Q4 1920 compared with Q4 the previous financial year. So the net revenue has been increased by 18.2 percentage. It's a positive sign. The net profit also increased by 17.7 percentage. The total advances increased by 21.3 percentage. And there is a good jump in their operating profit, that is 19.5 percentage. That is, a net income margin has been increased to 4.3 percentage, which is a good sign. And their total deposits jumped to 24.3 percentage. And their balance sheet size increased by 23 percentage. So now let's go to the valuation model. I have used a price to income valuation model. So this is a valuation model for HDFC Bank. So I have considered the past 5 years earnings growth, I mean the income growth, and the current market cap is almost 5 lakh crores, and the price to income ratio is around 3.39. That is market cap divided by the current income earned, that is 1.47 lakh crores. So I've segregated this into three scenarios. So scenario three is the best possible scenario, that is the average growth for the past 3 years is around 19.53. Assuming that this year also the HDFC might grow at 19.53 percentage. So that's how our possible target comes to around like 1096 rupees. Since there is an effect of corona, I have considered the other two scenarios. One is the average and one is the pessimistic view. So one is if you take the pessimistic view, if you could see if the growth, if it is around price comes to 980 rupees. If there is an average growth of 12 percentage, the possible target price is around like 1026 rupees. So the current market price of HDFC Bank is 910, so 910 rupees. So apply your prudency in investing before investing, and this is only for education purpose. And thank you. Thanks for watching. Subscribe us for more videos. Please do comment if you have any queries and suggestions. Thank you.